last week we were up at Thursday and Friday. It just seemed things were, I don't know, getting a little bit tired as we were hitting 200-day moving averages. Both of you think that the December, I guess the Christmas Eve lows set up what you guys are calling a tactical rally. So at least a snapback, but are we any closer to knowing which way this resolves itself now that we snap back a little?
I think, what a difference 7 weeks makes, because we were just so oversold, sentiment, valuation, not surprising to see a snapback. But I think here, all you have to do is look at the huge gap between the fourth quarter earnings, which we know were great, low double digits. First quarter's flat. This year's running at 5%, and it's back-end loaded, which always makes investors nervous because they know analysts tend to cut the numbers as the year goes on. We're only at 5% for 2019 because the fourth quarter's at 10. If you just took the first 3 quarters of the year, we'd probably be about 2.5.
Yeah.
So, I think it's not so much that the market is looking terrible here. It's just the risk-reward doesn't look that great. Maybe we've stolen from the rest of the year's returns might be one way that, we're looking at it.
If everyone went to 2750, you make some interesting points about what I'd call the Fed call. People know about the Fed put. They stop when the market's going down because they can't help themselves because traders, are so spoiled. The markets go down, so suddenly they get very dovish. But then when good things happen, if we get a China deal or anything positive happens, then they're back on schedule. They're like, maybe we will raise. So they start feeling good about things. They're going to raise. They feel bad. They're not going to raise.
Yeah, I mean, the trade might wind up being a bit of a catch-22. Obviously, if we don't get a meaningful deal, it's negative. But if we do get a deal that people believe in, it brings the Fed tightening back into the mix. So we just don't think the risk-reward is as interesting as it was a couple of months ago. And it's rare to see things change so much in 7 weeks.
So did you really get bullish in December, right at the lows?
Or I mean, we were buying back to neutral. We had gotten somewhat defensive in the fourth quarter, buying back to neutral at the end of the year to get back, thinking that we could have this bounce back in January, and then moving toward, more of a moderate overweight position across risky assets.
It speaks to me. I feel moderately overweight after. I don't feel like I'm like total fat, just disgusting, but close. Sort of a
Right. Do you ever feel underweight?
I do after I finish those horrible diets that the doctor up in Scarsdale,
No longer alive.
No, I know. Someone killed him because of that diet. I really think so. I mean, when I'm on that thing, I want to kill someone. But anyway.
Well, I don't think you want to be wildly bullish here. I think you want to,
So what does that mean? Okay, what's your year-end target? Give me an idea.
I don't have a year-end target.
Will we get to 28, 29,
but, I do think it's very, given the valuation starting point that we had this year, I think it's in a base case scenario, it's very easy to foresee returns of about 15% this year. You can make very reasonable assumptions about earnings growth, which we think is going to be probably zero for 2019. But all you really need is, the PE ratio to go from 14.5, where it ended the year, to 16, and you're looking at a 14% total return. If it goes to 17, then you're looking at a 19% total return. So I think at a base case, equity markets are going to do very well this year, assuming that we don't get derailed by a lot of the well-known risks that are out there.
But it was better December 24th.
Better than it is today.
No, but it was better to buy. You had 15% in the cards at that point. Now, are you saying another 15 from where we are right here?
Well, I'm saying 15 for the calendar year, so we're at about 8 or 9. So there's still
for the calendar year.
So there's still a fair amount of upside on the table. Now I do think given the move that we've had in January, that we're going to need some time to consolidate some of these gains. But I think if we're looking between now and the end of the calendar year, it still justifies an overweight position.
Consolidating gains means we don't go back below the Christmas Eve lows.
I don't think we do that. No.
We don't?
Well, I mean, I think that's a fair assumption at this point, but people need to remember we're 10 years into this recovery. The average drawdown in a recession on earnings is about 25%.
Yep.
So that takes you from about $1.70, which is consensus on the S&P this year, to about 130. Recession multiples drop to 12 or 13. If you do that, you get an S&P with a one handle on it, like 17, 1800. So again, who knows when the next recession comes, but when it comes, we will have a major drawdown. And you have to ask yourself, my upside's 5%, I think you just laid out. Potential downside of 40 or 50. So the risk reward here, I think, late cycle is just not great. And I think December was maybe a prelude. People need to think back to how they felt. And this notion that earnings just keep grinding higher and the economy just keeps growing in an uninterrupted, even flow, central banks stay dovish, it just seems all a little bit too good to be true. So we would just adopt a little bit more of some late cycle caution.
So, but I think that's a key judgment that we need to make, right, as investors. What is the probability of a recession within the next 12 or 18 months? And when we look at the high frequency indicators that we monitor to gauge recession risk, I'm not really seeing a lot of red, I'm not really seeing any red or yellow lights at this point. Whether it's the yield curve or initial unemployment claims, the Conference Board leading indicator, or credit spreads. In the absence of an economic downturn, I think PE ratios are more likely to go up and down.
I don't disagree. You're not seeing it now, but it's a bit of a game of chicken.
Yeah.
You're trying to squeeze out that last little bit of return, betting that you'll be able to get out in time. So I agree. We don't see it now, but investors just need to understand where they are in the cycle.